As an equity investor, there is a lot of happenings right now in the world. Geopolitical tensions, crude oil impacts, FII selling. There is a lot to process right now if you are an equity retail investor. To cut through the noise, we have with us Dr.V.K Vijayakumar, who is set to guide us through all these happenings in the world, how we can navigate through this turbulence. Welcome, Dr. V.K.
Thank you, Sony.
So, to set the context first, the equity markets, last 3 months, calendar year 2026 has not been very good. We've seen one of the worst March month since 2020. Where would you place the Indian equity markets right now?
Well, the war has impacted the equity markets. Globally, it has impacted equity markets. In India, more so, because India is a major oil importer, gas importer, and therefore our economy is vulnerable to an energy crisis. Therefore, since the war began, it's into the fifth week now, Nifty is down by more than 10%. Nifty mid cap is down 11%. Nifty small cap is down 11%. And NSE 500 also is around down 11%. So it is across the board. It is an across the board correction in the market. So if you take the period from the 1st of Jan to 31st March, Nifty is down by 14.6%. So that is a very serious correction. We are, as I said, an oil importer, a gas importer, and therefore our economy is more vulnerable, and the equity markets are discounting this vulnerability and a possible hit to the economy. Actually, at the beginning of this year, in January, we were in a sort of a Goldilocks scenario. Even the RBI governor in the December monetary policy review meeting said we are in a near Goldilocks scenario, GDP growth at 7.6%, inflation completely under control at 3%, fiscal deficit under control at 4.4%, current account deficit at 1%, forex reserves at $720 billion. Everything was going good. And therefore, the markets also were on the cusp of a recovery because the consensus was that FY27 earnings will see 15% growth. Right. So that was the scenario at the beginning. Things have turned topsy-turvy after the outbreak of the war.
Right. So crude oil, I think, has a bigger impact on a country like India, where we import 85% of our crude requirements. So if this continues, let's say the heightened price continues, where do you see that impacting? I mean, is it like a very desperate scenario wherein, our economy also starts getting affected because of that?
Well, as you said, the crude shock has impacted us. But there is another dimension to that. As you said, we are importing 85%, even more, of our crude requirements. Also, we are importing 60% of our LPG and 50% of our LNG requirements. And for these three, for crude, 50% comes through Hormuz Straits. For LPG, 85% comes through Hormuz Straits. And LNG, 50% comes through Hormuz Straits. So more than a price shock, this has become an availability shock, a supply shock. Okay. Many of the factories which use LNG, like vitrified floor manufacturing hub in Gujarat, have been completely closed down. It is more than a price shock, it is an availability supply shock. So crude on 27th February, a day before the war, was $71. Now, as we speak on 31st March, it is around $115. So it has gone up by more than 50%. That's a big shock. Now, there is a big uncertainty, as you said at the beginning. Nobody knows, even the people who started the war, do not know when the war will end. They are also looking out for an exit strategy to end the war. So how this will impact the economy and the markets will depend on the duration of the war.
Okay.
The duration of the war is important. If the war ends in, let us say, 1 week or 2 weeks, very much possible, anything
Right,
can happen.
right.
Then the hit to the economy will be very, very insignificant. There will be a hit, but it will be insignificant and something which we can absorb.
Right.
But if the war prolongs for, let us say, more than a month or 2 months, and if Brent crude stays about $100 a barrel, then there will be a big hit to the economy.
Right.
Our GDP growth, which was projected at 7% before the war, for FY27, can come down all the way to even 6% is possible. Inflation can spike
Right.
to 4.5%. Rupee has already depreciated by more than 4% after the outbreak of the war. So there will be imported inflation as a result of that. So ultimately, it all boils down to the duration of the war.
Right. So that brings me to my next question.
Yes.
In all your decades of stock market experience, you've been through many conflicts, many wars, short duration, longer duration. Where do you see this, and how would it impact, in your experience? How does it impact the stock markets? Is it a correction that we are in? Is it a temporary one, or is it the correction that investors fear? What is your views on that?
So that's a very interesting question and a very pertinent question also. Well, if you look at the history of military conflicts and the impact of these military conflicts on the market, an interesting commonality is that the military conflicts impact the markets only in the short run,
Okay.
not in the long run. They don't have a long-term impact on the market. You take the last more than quarter century, let us say, start with the Kargil War of 1999. Then you go to the September 11 and the US attack on Afghanistan. Then the recent episodes of, let us say, the Russian aggression in Ukraine, our own Operation Sindoor, and before that, the Israel-Hamas conflict.
Right.
All these had only a temporary impact on the markets. The markets quickly recovered. A few months after the event, the markets were at levels higher than the
Right.
levels at which they were before the event. So, in brief, I would say, if you look at the last 26, 27 years of history of military conflicts, the impact on the markets has been short-lived.
Okay.
But then this time, I will not say with certainty that it will be short-lived. We don't know. But then the difference this time is that this conflict, this West Asian conflict, has triggered an energy crisis. All the conflicts which I explained just now, starting with the 1999 Kargil conflict, or even the Hamas-Israeli conflict, did not create an energy crisis
Okay.
globally. The Russian invasion of Ukraine did, but that was only temporary. It was not global in nature. We did not have any supply shocks as far as gases were concerned. It was only a mild price shock. So this time it is an energy crisis and a supply shock. Therefore, it is a little bit serious. So again, my answer to your question is whether it is a one-time blip or a correction which can be of a longer duration. That depends on the duration of the war, and about which we do not know much now. But my own gut feeling is that the war is unlikely to last long, because nobody wants a prolonged war. It is in no one's interest. Right? US economy will start facing the music. Already the prices have gone up, petroleum prices, yes. And there is popular protest.
Yes.
And President Trump's popularity rating,
Right.
popularity is the wrong word in his case, it has gone down. So there is a very high probability of the Republican Party losing big time in the midterm elections coming up in November. So it is not in America's interest to prolong the war longer. Coming to Iran, they are putting up a very brave face, and the resistance has been much better than what anyone expected. But then the economy is in shambles. Inflation is running at 100%. Many things are not available. The currency has crashed. Therefore, for Iran also, continuation of the war is...
So it is expected to...
Yes.
Yeah,
Therefore,
so-
it is unlikely to last long.
The other thing that has been impacting our markets, of course, the whole scenario of US-Iran war, FIIs has also been consistent sellers over the last few months. Of course, we had few periods wherein they had inflows, but
More than a year now.
so do you think they will come back once this conflict is over, or you think they have better options elsewhere in the emerging economies?
FII's strategy of sustained selling in the market has been a major area of concern. Well, FIIs have been selling continuously since
Have they
September
been investing
2024.
somewhere else?
But this month they have sold even in South Korea and Taiwan. Everywhere they have sold. Because of geopolitical uncertainty, they have sold. If you take the March data, Taiwan and South Korea were two markets which attracted a lot of money, and they did well among emerging markets. These two markets did exceedingly well because they were participants in the AI trade also. But even these countries experienced FII selling out. In India's case, we have to see this in proper fundamental context. And what is the context? See, Nifty rallied from 7,511 in March 2020 to 26,216 in September 2024. That was the bull market, the big rally that we had. And this rally had a fundamental support because during this period we had 24% CAGR earnings growth. So that earnings growth, fundamental support was there. But then suddenly what happened, FY25 saw earnings dip sharply. Earnings growth was only 5%. So what was the scenario by the end of 2024? We had a price earning multiple of 21, 22 and earnings growth of 5.
Right.
Whereas in a country like South Korea or Taiwan, for instance, or many markets like that, Hong Kong especially, the price earning multiple was 14, 15, 16 and earnings growth was 20%, 30%, 40%.
So much more attractive.
Yes, far more attractive. So the FIIs were fundamentally justified from the fundamental perspective in selling in the expensive market and moving the money to cheaper markets which were cheaper in valuations and earnings growth was much better. Therefore, if the FII strategy is to reverse and if they are to turn buyers in India, earnings growth has to come back. Actually, we were on the cusp of a revival in earnings growth. As I said at the beginning, FY27 consensus estimate was earnings growth of around 15-16%. That is why, if you recall, in February, FIIs were buyers.
Exactly, yeah.
After a long period of sustained selling, in February they turned buyers, but in March they have sold as if there is no tomorrow. $12 billion have already been sold. But I think once the situations normalize, once the geopolitical threat is over, I think war is not a permanent thing. It will come to an end. So once we have normalcy there and crude prices come down and gas availability is restored to normal levels, well, India offers very good chance. We must understand last year 2025 was mainly an AI trade. And India did not participate in AI trade. AI leaders were the US, China, Taiwan, South Korea. Therefore, there will be some movement of money towards non-AI trades also. One thing that we have to remember is that no other economy has as much long-term prospects as India has. And also a wide variety of industries to choose from. In Taiwan, if you take 40% of the market cap is just one company, TSMC, right? Pure AI trade. South Korea also a few companies which are mainly AI trades.
Which have benefited.
Which have already benefited. In India, you have dozens of industries and a few hundred stocks, which holds very good promise. So the FIIs turning buyers is only a question of time, but our patience will be tested.